Welcome to this introductory session on financial modeling and analysis. Let us first understand what is financial modeling. Financial modeling involves the preparation of detailed company-specific models used for decision-making purposes and financial analysis purposes. Financial models can differ widely in complexity as well as in application. Some can be as simple as one-page model, whereas some might run into multiple sheets. Sheets built to get a quick and dirty estimate for the next year's net income. Some span more than 40 worksheets and project various scenarios for the value of a company. Let us now see a few examples. Reported financials for past years are the basis for most projections in the models. To forecast financial statements, we make use of key performance indicators derived from the historical records. Projecting future years for the three main financial statements, the income statement, the balance sheet, and the cash flow statement, is typically the first step. Income statement estimates for EBITDA and interest expense as well as balance sheet leverage statistics such as debt equity and interest coverage are often the most important model outputs. Third, incorporating financial statement analysis through the use of ratios. More often, profitability, liquidity, and solvency ratios are calculated in order to pinpoint any weaknesses in the financial position of a company. Fourth, performing valuation. Valuation involves estimating the value of a company using various techniques, although the most commonly used are comparable company multiples and discounted cash flow modeling. Fifth, conducting various forms of sensitivity analysis after forecast model has been built. These analyses are often the real reason a model was built in the first place. For example, sensitivity analysis might be used to measure the impact of one model output, say free cash flow, from the change of one or more model inputs, say revenue growth or company's working capital needs. For example, what happens to free cash flow if we increase sales growth by an extra 2% next year? At the same time, reduce the payment terms to the suppliers by 5 days. Financial modeling is about decision making. There is always a problem that needs to be solved, resulting in the creation of a financial model. Financial modeling is about forecasting. A good financial modeler must first of all have a thorough understanding of the generally accepted accounting principles and the statutory accounting principles. They must know how the three financial statements work and how these are linked with one another. They need to know corporate finance theory and are able to apply it in valuation exercises. They will have to be adequate in forecasting. Finally, they will have to think analytically, be good at business analysis, possess industry-specific knowledge, and last but not the least, have a strong Excel skills. For the finance and accounting professionals in corporate finance and investment banking, financial modeling is largely synonymous with cash flow forecasting and is used to assist the management decision-making process with problems related to historical analysis of the company, 1, 2, projecting a company's financial performance, 3, business or security valuation, 4, benefits of merger, acquisition, etc. 5. Capital budgeting decisions. 6. Scenario planning. 7. Forecasting future raw material needs. 8. Cost of capital calculations, financial statement analysis, and restructuring of our company. The same applies to equity research or credit analyst, whether they want to examine a particular firm's financial projections along with competitors' projections in order to determine if it is smart investment or not. To forecast future cash flows and thus determine the degree of risk associated with the firm. Furthermore, for small business owners and entrepreneurs who would like to project the future financial figures of their business, financial modeling will enable them to prepare so-called pro forma financial statements, which in turn will help them forecast future levels of profits as well as anticipated borrowings. Finally, as more and more companies become global through the acquisitions, establishments of international operations, there is an imminent requirement for sophisticated financial models. These models can assist the business and financial analyst in evaluating the performance of each country's operations, standardize the financial reporting, analyze complex information according to the various industry demand and supply patterns. Let us now understand what do we mean by financial modeling process, right? So after understanding the what is financial modeling, let us now understand the process that is being used for financial modeling. Step number 1, and the most crucial step which any financial analyst or financial modeler has to have clear understanding about is define a problem. Step number 2 is specify the model. Step number 3 is design and build the model. And step number 4 is check the model's output. We will further discuss all these steps and details in our next sessions. Thank you.